Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include the latest from the Optimal Blue lawsuit, my interview with Cotality's Thom Malone on home price trends across various regions of America and what that portends for affordability as we move toward 2026. And obviously rates are quiet with no economic news of note, but what did we learn yesterday in the minutes of the September FOMC meeting? Looking for an all-in-one automated VOIEA platform that helps mortgage providers achieve up to 50% cost savings and industry-leading 75% completion rate? Look no further than Truework. You can learn more at truework.com. Two lawyers walk into a pub. They order a couple drinks and take subs out of their briefcases. They begin to eat. Seeing this, the angry pub owner exclaims, "Excuse me, but you cannot eat your own sandwiches in here." The two look at each other, shrug, then exchange sandwiches. Legal news leads off the news today as Optimal Blue and nearly 30 originators were hit with a lawsuit alleging price collusion impacting millions of borrowers, noting these lender spreads were about 2.7 basis points or 49.2% somehow higher than others, and that mortgage payments surged 54% from 2022 to 2025. The sooner you fall behind, the more time you'll have to catch up, right? For originators who don't want to fall behind, yesterday's commentary discussed the countdown to Halloween, and thank you to the person that wrote in, quote, "In the mortgage world, Halloween is celebrated by licensing and compliance folks as Renewal Eve, as NMLS opens the renewal window on October 1st. All licensees should make sure their continuing education is done before then so they can renew ASAP and avoid lapses in licensure." Well, we're on rules and regulations. Do the number of working IRS employees correlate with the chances of being audited? Some hope so, as 50% of IRS employees are expected to be furloughed. Turning to rates, the U.S. Treasury followed Tuesday's solid 3-year note sale with a weak $39 billion 10-year note reopening yesterday. The auction tailed less than 0.5 basis points, but the price action on the follow was poor and the yield curve remained flatter in the ensuing sell-off. For today's interview, I want to welcome back to the show Cotality's Thom Malone to talk about home price trends across various regions of America and what that portends for affordability as we move toward 2026. He's principal economist in the office of the chief economist at Cotality, where he's responsible for analyzing housing markets and home price trends. He has an extensive background in urban and real estate economics and applied econometrics.
People at this point, or at least frequent listeners of this podcast, people that are intimately involved in the real estate, housing, mortgage industries, they understand real estate's pretty local. And so to look at national indices give you a good sense of kind of general trends, but it could be even within one state. One metro is rising rapidly and another one is decreasing markedly when it comes to prices. After going on that little rambling monologue of mine, can you give us general trends we're seeing in the overall index out there and kind of big takeaways for you?
All right. General trends, it is weakening and continuing to weakening. It's been the year-over-year numbers. It started off the year at about 4% and has been steadily dropping throughout the year. And in July, it was down to 1.7% for the national index. Particularly on a monthly basis, not an annual basis, prices were down 0.2%, which is very different from a usual July. You know, historically, July is a middle of the road kind of appreciation month, gets about 0.5% or so appreciation. And if you look over the country, there's one patch of cities where prices are still going up, and everywhere else in the country they're going down. And that patch where they're still going up is the Midwest. The top cities on monthly appreciation were Cleveland, Chicago, Minneapolis, Detroit, 1, 2, 3, 4. And that's kind of the only really bright patch in terms, if you consider rising prices good, bright patch. If you're hoping to buy, maybe it's not a bright patch. But that's the only really bright patch in terms of price appreciation. It's down in all the other major cities that the Case-Shiller Index records monthly.
Well, if you look
down across all price tiers too, so it's not really a sort of patches of the metropolitan area thing. It's more a specific. It's a greater regional thing. Than like if the high price homes in the city, if their prices are dropping, the low price homes are dropping too. It seems more of a geographic kind of thing, a larger geographic unit than, just neighborhoods within the city being hot or not. It's hot cities and cold cities.
I was looking at the index since its inception in the late 80s, and I guess if you look at overall trends, the index rose nationally from 1991-ish, 1992, up to 2006. And then we all know what happened in 2006,
Hmm.
about 2011. So that 91 to 2006, that's about 15 years. 2011, 2012 is when it reached a dip again. If you go by that same 15-year kind of upswing, we're due for another drop here soon. And so that's obviously a naive way to look at a graph, but what do you think about kind of these 10, 15-year build-up cycles of home prices before some sort of market correction? Am I viewing things obviously I mentioned naively, but your thoughts on kind of general trends with rises and falls with real estate?
Well, I don't remember the exact year off the top of my head, but the index actually goes back even further than what you've said. Like, the official S&P Cotality Case-Shiller index release starts in the 90s, but Bob Shiller himself, along with Case, the creators of the index, have additional estimates going back to the 60s for it, that they personally kind of own. And you can combine it with that and with what you were saying. And in real terms, home prices didn't really ever go up until the early 2000s. Of course, they went up and went down, and they've gone up again. This is to say that in the long history of the index, home prices have ever really gone down in a major way once, right? So to predict based of that feels kind of odd because it's like, prices have gone up once and then they went down. Prices went up again.
Yeah,
Um,
I know.
that's well, they perfectly who knows. The conditions are very different this time, right? Namely, people have much more equity in their homes. Borrowers are much safer. So you know, rates went up. People were relying on the appreciation of the home to make the payments last time, or the last time homes crashed. So there, there was a clear reason for why prices would crash. So prices could crash, but you need a reason for it beyond just, well, they went up, so they must go down, right? And
Fair enough.
in assessing that, it's kind of the overall view of it, like our index, our forecast for the next year is at the next calendar year is at 3.9%. But there's a range to that, and it's broadly just saying like muted. We should expect kind of muted appreciation over the next year or so. In order for prices to drop, people need to sell prices at a lower. People need to sell homes at a lower price, right? So there needs to be some kind of external event that forces them to want to sell their homes. And there's just not necessarily that external event when people have so much equity right now. Like the usual thing you argue is like, okay, there's going to be maybe if there's a recession and there's job losses, people might not be able to make their payments. They might need to sell their homes. But even if a recession would come, it's not clear that the homeowners are going to be the ones that lose their jobs, right? Like going off recent jobs reports, it's not so much a case of people losing their jobs, why jobs numbers have been weaker, as much as people not hiring, which means that recent graduates aren't getting hired, for instance, and recent graduates probably don't own homes. So they're not going to be the forced to sell by not getting a job and not being able to make payments. And the people who have homes, they're retired or they're still staying in their job and they don't necessarily need to sell their home. So, you kind of need the reason for people to sell their home, for a large number of people to sell their homes for prices to drop. and it's not really clear what the source that would be. And in that situation, you more get a long period. You would more expect a long period of very slow appreciation, or possibly even slightly negative appreciation, whilst incomes and the economy tries to catch up with prices. So it's like, we had like a decade or more of appreciation in 2 years. And now prices will stall while incomes and such try to rise up to that same level to be able to afford those homes. So it's, yeah, the most likely situation seems to be owners hold on to their homes and wait until they get the prices they can get, and that'll happen when people can give them the money they want.
Well, you mentioned the Midwest previously, and I think that we're seeing that's the one region with home price appreciation. It makes me think there's almost a leveling out there where people are going, gosh, it's so unaffordable to own a home, but I want to own a home. Where can I do it? And the Midwest has become that place for a variety of reasons. Can you dive into the trends you're seeing across regions, kind of West, South, Sun Belt, Midwest, Northeast? What the factors are that are driving home prices in those different regions?
Yeah, it's kind of an affordability story, but in the Midwest, it's sort of like the Midwest is probably the most affordable place in the country. Right. So if you're gonna move somewhere and buy a home, demand would reorient there. There's also kind of a waterfall story to this. Like right now the highest prices are rising in the Midwest, and they're starting to dip in the Northeast. A year ago, it was in the Northeast. Well, a year and a half ago, prices were rising in the Northeast a lot. A year to 2 years ago, before that, it was Florida rising. And it's kind of a it's kind of a waterfall, and it's the sense that you're seeing maybe the same cycle playing out in a different sequence across a bunch of areas. So you can think of this in a way that demand boomed at the start of the pandemic and prices went up in the most expensive parts of the country first, because you could perceive those are the places where they have the highest paying jobs and maybe where the people most want to be. Then prices get bid up and so let's say that's New York, prices get bid up in New York. Eventually prices rise enough that the differential between that and say Florida is enough that people look and say like, okay, New York isn't worth it anymore. Demand reorients to Florida. Florida prices get bid up, and eventually they get bid up enough from the next place. Demand reorients there, and so on and so forth. So it sort of starts in the more expensive places and moves its way down the chain. And then, you get the flip side when prices start dropping as well. So it could be that the Midwest right now is kind of just experiencing its growth in that point in the cycle, and maybe in a year or so, in a year or 2 years, demand will have reoriented itself to the West Coast and the Northeast, and prices are going up there, and then we'll see it reorient itself to Florida and Texas, and prices will go up there, et cetera, et cetera.
Things you're keeping an eye on as we move forward, trends that pique your interest, or give people, people that are casual watchers of home prices, kind of some intel on where to, uh, look, focus their attention.
I really want to keep my eye on the California markets and the Florida markets, because there's definitely, like, what I mentioned before in my previous answer, there's some kind of national cycle that's playing out of all these places with different sequences, but that's not to deny local impacts. And rising occurrence of natural hazards and the degree of damage they do in those places means rising insurance premiums, which means much lower affordability. How's that going to play out in those places? Is demand really going to reorient there at some point, or is the growth in insurance premiums going to outpace that? So the client, natural disasters, raising insurance premiums is one thing I've really got my eye on, and I'm wondering about, particularly in Florida and in California. Different natural hazards in each place, obviously, but
And I will add too, Tom, we'll do a bonus question here. Listeners of the show might say, oh, his accent doesn't sound like an American accent. What intrigues you so much about the American housing market coming from, at some point, an outsider's perspective?
ooh, all right. This is my favorite question when I get to talk about my. I'm a dual citizen of New Zealand and the US, right? So I grew up in New Zealand, so I get to talk about where I grew up's home prices. So the interesting thing here, when you compare the US national home prices with, let's say, New Zealand, Australia, the UK, Canada, prices went up everywhere during the pandemic. They have dropped a lot in New Zealand or Australia or Canada or the UK compared with the US. And it's New Zealand, for instance, is in prices went up, about 40%, dropped about 40%. In real term, if you account for inflation, price appreciation from the pandemic since the pandemic is now zero. Yeah, like it's been wiped out because you've got 20% drop, say 20% inflation, zero real price appreciation. Yeah, we've had inflation, but the appreciation has stayed up, so we've still got, so prices have more remained flat and not dropped down, certainly. And that's probably because we have fixed rate mortgages in this country would be the most likely reason. Like, in say New Zealand or in Canada, the mortgage market works such that mortgages don't go to Fannie and Freddie, they don't get securitized, and the risk doesn't get diversified. So when you get a mortgage, it stays with the bank, and they're the ones bearing the risk. They're not selling it on to a GSE or something like that. So they can't really take on the risk of offering like a 30-year fixed rate mortgage. Instead, what you've got is basically you get your mortgage, and you've got a menu of like I can pick 1 year at 5%, 2 years at 6%, 3 years at 7%, etc. And then you'll pick those terms for your mortgage, and then a couple of years later, whenever those are up, you'll have a new menu reflecting the current market. So in those markets, people have basically seen their interest rates shoot up, whereas around here, people can rely on their fixed payment, and their payments haven't gone up. So there hasn't been the need to sell to get out of your payments rising as there has been in those countries. So that would probably be the main reason why prices have dropped in those places and not around here. So basically, the U.S. is standing alone and preserving its gains from the pandemic, and it's probably because of how the mortgage markets work here compared with other countries.
True, and I would argue it's healthy to have corrections every now and then, so it might not be the worst thing in the world if we see that here. Tom, I really appreciate the time, man. Always a pleasure talking to you, and hopefully I'll have you back on sooner than this last little gap since we had you on last time. So I appreciate it.
All right, no worries. Great talking to you.
In Federal Reserve news, the Fed minutes from the September meeting were also a bit more hawkish than expected, with significant differences of opinion within the committee and multiple participants in favor of keeping rates on hold, though when it came time to vote, almost all supported the 25 basis points rate cut. Most of the participants supported further rate cuts over the rest of the year, too. Jobless claims and wholesale inventories would normally kick off today's economic calendar, but are expected to be delayed due to the partial government shutdown. That leaves the rest of the calendar to Fed speakers and Treasury, along with Freddie Mac's primary mortgage market survey. Treasury activity will be headlined by an auction of $22 billion of reopened 30-year bonds, and Fed speakers include Chair Powell, Vice Chair for Supervision Bowman, Governor Barr, Minneapolis's President Kashkari, and San Francisco's Daley. We begin Thursday with agency MBS prices, little change from Wednesday's close, the 2-year yielding 3.59 and the 10-year yielding 4.13 after closing yesterday at 4.13%. Let's wrap up with a joke and some housekeeping. What am I wondering eyes behold? After a brutal late autumn windstorm, I noticed that my young elm tree had finally lost all of its leaves in preparation for the cold, snowy winter ahead. I smiled to myself, realizing how nature helps all creatures prepare for the coming seasonal changes. But then my gaze was drawn to a red shotgun shell which had lodged near the top of the tree. I don't know if it was ejected there or carried by a bird, but you can imagine my surprise at seeing a cartridge in a bare tree. But Thanks again to Truework for sponsoring today's podcast. Truework is the only all-in-one automated VOIEA platform that helps mortgage providers achieve up to 50% cost savings with an industry-leading 75% completion rate. To learn more, visit truework.com.